$500. So who do you think is going to have a higher credit score? Just on credit cards. We're talking about just credit cards right now. Veronica?
What was that question again? I was reading the.
$500.
Hold on, wait. I was reading the comments.
Oh, okay.
Okay, go ahead.
So okay, we're taking two example of somebody with revolving debt, right? Credit card, because that's a big part of this, right? So if somebody has a, let's say, make it easy, $1,000 limits, two individuals with $1,000 limits on their credit card. This is called a Discover card or Capital One. It's popular, right? So let's say one person owes $100 on that same Capital One $1,000 limit credit card, and you got person B owes $900 on that $1,000 limit credit card. So what do you think the big difference in FICO score is going to be? Just one credit card.
Oh, it's going to be huge, especially for the person that owes 900.
Yeah, so that means again, the utilization is almost 90% on that credit card versus somebody who has made 10% use on the same $1,000 limit credit card. So what happens is you're going to see the disparity in FICO scores, right? You're going to have one person, the one that owes nothing on their credit card, this $100 one, as for the example purposes, their FICO score is going to be possibly 750 points versus the second person that owes $900, their credit score is going to be in the 600s. So that's a huge difference when you're getting, especially when you're getting a mortgage, right? Because that has a lot to do with what type of, program you're going to have, how much down payment you're going to put down, and especially if you're getting a conventional loan, what type of rate you're going to have. Because I mean, now you see posted everywhere, okay, rates went down. I get that. Okay, well, what's the rate today? Well, the rate today is not everybody's rate. It changes for everybody. It depends on obviously their loan to value and their FICO score and how much they pay for mortgage insurance sometimes. So again, credit is a big part as far as getting a loan and understanding how it works. And especially, again, that's why we recommend having a loan advisor sit down with you before you start the purchasing process. Again, if you can run your credit, it's like going to the doctors, pretty much, right? I always say, going to checkup once a year. People do that. You're supposed to, right? No different than financial. Hey, you should be sitting down with a professional and having them review your credit report once a year. Your credit report and making sure that there's no discrepancy. Questions? Anyone? Veronica, you want to add to that?
No, not yet. I'll let you go on, then I'll chime in.
Okay. Take this off my screen here. Perfect. Okay, so now some folks out there, obviously they have, let's call it less than perfect credit, right? They don't have a 700 FICO score. So they have a life event. So maybe they had a foreclosure in the past, maybe they had a short sale, maybe they fell for bankruptcy. So it depends. So we do have a loan for everyone. No matter what life event they've had in the past, they can still be homeowners. Now, obviously, it depends what the type of program you're looking at. So here's a little breakdown. For example, conventional loan, FHA and VA loan for veterans, right? So it depends on the circumstance. If you had a bankruptcy, most cases you have to wait 4 years, right? If you're doing an FHA loan, you only have to wait 2 years. So really, that's the lowest. 2 years is probably the minimum waiting time for an FHA loan. And then foreclosures, obviously, you got 3 years, 2 years. So it's just kind of a little breakdown as far as their specific, life event that happened. Questions, anybody? No.
Well, I do have a question because I noticed for the foreclosure, if somebody has a foreclosure for the VA, they only have to wait 2 years versus the conventional, they have to wait 7 years. Why is it only 2 years for the VA and 7 years for the conventional?
Great question. So remember, so who sets these parameters, right? You have to, who's behind it, right? So at the end of the day, conventional, you got Fannie and Freddie, they set the parameters. FHA, you got, the Housing Administration, and the veterans, they set their own parameters. They're actually, they're only ones that have 0% down versus the other programs they require a down payment. Why is that? Now they have found studies that they've done that veterans, don't ask me why, their delinquencies are very low. There is no very little delinquency. So they pay their bills on time. I don't know what it is about military people, but they do. So the risk, their VA is willing to risk that and again, make it easier, set standards that are easier for veterans than, civilians. Those are the parameters.
So would you say the people that are veterans, for them to, if they do have a foreclosure, and since they only have to wait 2 years, if they do have a foreclosure, but you said the foreclosure rate for them is low anyway, every now and then I'm sure there's somebody that may be a veteran and have a foreclosure. So the fact that they only have to wait 2 years, what would be your advice to them during those 2 years? As far as restoring their credit after the foreclosure?
In any good question. In any event, foreclosure, bankruptcy, whatever the event is, I mean, we always they're getting a fresh start. Definitely recommend to rebuild their credit, right, in those 2 years. So do whatever they can to increase that. Again, do a checkup. Number one, to see where you're at. Okay. Number two is finding out, okay, what can you do so you can increase that FICO score? I mean, let's just say they have a FICO score of, I mean, it can't get as low as I've seen 400s. So what do you need to do to get that increase as fast as you can within those 2 years? And there's a lot of things you can do, absolutely, to get it increased. But again, the step number one is to get, with a loan advisor that you trust and sit down with them and making sure that they give you a plan, a guide towards that. So nowadays, the nice thing about it, when I started, there was not much technology. Now it's like amazing how much technology is out there. I mean, we can run so many different evaluations, simulators to get us to exactly the pinpoint what score we need. I mean, I've had clients who have literally, applied, they had a X score. When they went into escrow, score drops, so there's ways we can turn that around in a couple of days and increase your credit score. We have those tools these days, which we didn't years ago. So we definitely can, again, help them out and set the plan. Depends what score we're shooting for. Sometimes, I'll give you an example. I know we're getting ahead of ourselves, but down payment assistance programs, for example, don't require a high FICO score. They just require 640. Actually, we just got one that requires just a 580, which is amazing. First time I heard that. This just came out. So
the score only has to be 580?
Yeah, we just got a program that we can combine with an FHA and 580 minimum FICO score. So they're being more lenient as you hear. But if they have let's say in this case, if they need a 580 and they have a 550, so we don't need that much to raise it. So it depends how far you need to get. If you have a 560, you need a 640, it's gonna take a little more work probably on their part. But there's definitely a lot of ways we can, explore. Every situation can be a little different. So hope I answered your question.
So basically, all is not lost after a foreclosure, short sale, bankruptcy, Chapter 7 or 13.
Absolutely not. Absolutely not. Never lose hope. Never lose hope. There's always, again, there's so many types of programs out there. You'd be amazed. So definitely there is a program for everyone's situation.
Okay, well, I don't have any more questions on that.
All right. So here's some of the programs options for, again, if you have a low FICO score. I mean, we talked about the FHAs, they go as low as 580. Now that one, like I said, we can now, as of a couple weeks ago, can combine it with a second mortgage. They'll take care of what you see 3.5% down. So literally you're buying a house, Veronica, with 100% financing. I mean, you're just, again, we're covering the financing for you if you qualify. Now, obviously the closing costs on top of the down payment, right? We know that. But then VA, that's the minimum FICO score that required. VA is 100% financing all veterans. USDA minimum 640, conforming loans 620. We have those special programs with Home Ready, Home Possible, 620, 660. And then we have our non-qualified mortgages that are as low as 640. So the difference between the non-qualified, I get that question a lot. What is a non-qualified mortgage? So just the opposite from a qualified mortgage. So qualified mortgages are your Fannie, Freddie, which are conforming loans that we have out there. FHA loans, anything veteran loans, VA loans, USDA loans. So anything that doesn't fit those boxes that are, again, government, Fannie, Freddie, conforming. So what happens, now these non-QM, non-qualified mortgages are going to be not backed up. Because remember, these other loans that we talked about, conventional, FHA, USDA, VA, now they're backed with the government. Non-QM or not. Those are backed by investors. Investors can be, who knows from where, China, who knows where. I mean, they're just people that have a lot of money. They pull it up and now they want to lend, right? So those are non-qualified mortgages. A little more, how can I put it, more creative? I mean, they'll do bank statements, so a lot of different creative ways that they're doing stuff. Asset depletion. I mean, you literally don't even have a job. I mean, they'll let you borrow money if you have money in the bank. So we can get into non-QM for a whole session, a different session, Art, but definitely a lot to dig in there.
Question. So I heard they have bank statement loans.
Yes, non-QM. That would be through a non-QM. Not your regular government, Fannie, Freddie would not do just a bank statement loan.
So a bank statement loan is more conventional or
non-QM? Non-QM, no. Conventional would be your regular Fannie.
Conventional.
Yeah, Fannie, Freddie, FHA.
So a bank statement loan is a private investors?
Yes, non-QM. Anything that's non-QM would be a private investor, correct?
Okay. Can you explain for somebody that may be watching FHA? Because we know what FHA means, and I know you just mentioned it, but can you just give a brief, easy understanding of an FHA loan? Because you say, to people, oh, you can go FHA, but I don't think a lot of people really know what FHA means.
Right. So FHA obviously stands for Federal Housing Administration. It's just another branch of the government. I mean, at the end of the day, I always tell folks, hey, we work for the government, because if whether for them backing up these loans, we would not do loans, right? So FHA is just another branch versus it can get confusing. Trust me, even when I started doing loans, it was very confusing. So you have Freddie and Fannie, who are another branch of the government, right? So at the end of the day, so why do an FHA loan versus the conventional loan? Correct? What's the difference? So what's the biggest difference? So an FHA loan is going to be a little more lenient. As you can see here, in the slide, they go as low as 580, where conventional, if you notice, they'll go only as low as 620. So now the biggest difference comes in, obviously, if you have somebody with a 580, 600, or even, I mean, honestly, I recommend anybody below a 680 to start looking at FHA's loans, because you're going to pay mortgage insurance if you're not putting down 20% down, regardless. So if you're not putting down 20% down, you're looking at these programs. Now, if you want to do, obviously, conventional is your best program. Hands down, it's going to be your better loan. But sometimes, depending on the client's circumstance and where they're at the present time, conventional loan is probably not where they can start. They probably most likely need to start at an FHA level. I'll give you an example. Obviously, you have a bankruptcy. You have to do an FHA. You have no choice. If you have a low score, you have to do an FHA. You got no choice. But eventually, you want to refinance those loans and get out of the FHA, because FHA is not your best program. It's not your best option. Conventional is. I'll explain why. So FHA, they charge, as we know, mortgage insurance. So does conventional. FHA charges mortgage insurance, you can call it twice. Double dip, whatever you want to call it. They charge monthly, and they finance the mortgage insurance as well. And that finance part, it can be 10,000, 8,000, it could be a big chunk of change, right? So where conventional only charges monthly. But the problem with conventional is that if you have a low FICO score, let's say you have a 630 FICO score. I had one recently, and they wanted to do conventional. But when we ran the price, the mortgage insurance part was a ridiculous $600 a month. Where again, that was too much just for mortgage insurance, right? Because he has a low FICO score. Now, on an FHA, the difference was now it's $230 a month, which is a big difference if you compare apples. If you do a comparison, FHA was a better, again, at the end of the day, they were paying less on an FHA than they were in a conventional. So FHA is not really driven by a FICO score. So you can have a low FICO score, and again, they're more flexible. They take on more risk. That's why they charge a little more, right? But it is easier to get a loan, a client who had less than perfect credit on an FHA than a conventional. Now, if the client comes to me and they have a 800 FICO score or 750 FICO score, yeah, absolutely. No doubt in my mind. I should never, I would do somebody a disfavor by putting them in an FHA loan when they have a high FICO score, mortgage insurance is reasonable, and again, instead of an FHA. So I see that all the time. I see people put in the wrong program. It can't happen. It can't happen. So, and normally it's maybe a somebody new to the business, new loan officer who doesn't really sit down and do a comparison. But really should do at the end of the day. Okay, if you're a client, first-time home buyer, which is who we're talking to today, is do a comparison. Hey, I want to see the FHA loan and I want to see a conventional loan. So you can make a decision. What's at the end of the day, our job as advisors is to give you options, give you guys options so you guys can make the best choice and recommend the best choice. But hey, let you look at the different options out there. I know that was a long explanation, Veronica, but
No, that was good. So I don't have any other questions on that.
okay.
But if you go back to credit, I do have a question.
No, go ahead.
I see you're getting ready to talk about that right now.
Collateral. Well, next one's collateral. So, but you have a question?
Okay.
Are there any questions on the chat, Damaris? No?
Well, I do have a credit question.
Go for it.
So when you were talking about FHA and you're talking about a 580 credit score, does that mean they'll pay a higher interest rate?
Come again?
When you were talking about FHA and you said a first-time buyer, if they had a low credit score of 580, the better program would be FHA for them. Would they pay a higher interest rate?
Now the funny thing about it too is that now you mentioned that FHA versus conventional, right? FHA's rates are better, okay? But when you do a comparison, again, sometimes the conventional is going to be, even with a higher rate, it's going to be a better payment overall. So remember, when you start, I mean, nobody wants to pay mortgage insurance forever, right?
Right.
Nobody. So again, if you start a loan and with a convention, the other big difference, conventional loan, let's just say the difference is not much, a couple of dollars. I would go with a conventional, even though it's higher. Why would I do that? Because that mortgage insurance will drop off automatically. So whatever it'll drop off. You don't have to refinance. You don't have to do anything. It'll drop off. Versus an FHA, it never drops off. You pay that forever, ever and ever. That's why I see clients, I go, why do you still pay 10 years later? You're still paying for mortgage insurance. They need to refinance. Okay, and when you refinance, no matter what, there's always a cost to refinancing, no matter what. No cost loans, they hide it somewhere, so it's hidden somewhere. So definitely there's a cost. So to avoid the cost, obviously conventional loan, even if it's a slightly higher payment, I would definitely go with a conventional.
Okay, so even though they go FHA, they have the lower credit score, they might even have a low rate, but they still will pay the mortgage insurance premium.
Correct.
Okay,
Yeah, but FHAs usually do have a better rate,
okay,
but you can't just look at rate.
right. No, I understand.
And people always, believe it or not, they fall for that. Especially if you're not, again, if you're not in the business, first thing you come to lead to is say, hey, the rate's better. Why am I take a higher rate? See, they don't look at the difference. They don't look at everything. They have to really dissect why the FHA is better or conventional loan is better. So it's a big difference.
Okay,
Okay, appraisal. Let's talk about collateral, right? So appraisals. So I'm just going to read this. The appraisal generally should be equal to or greater than the purchase price. So properties must be in good condition. Certain loans require specific condition of property. So a lot of folks, realtors, Veronica, I know you guys don't like FHA loans because approvals, right? Because they do require more, right? At the end of the day, VA and FHA, they actually look at the borrower's best interest always. Where conventional, they'll let things slide. You have a broken window, not a big deal. But FHA, health and safety, all the stuff that you see here, they must be fixed before you move into a house. So they're looking at the best interest of the buyer, nobody else. So a lot of times this is why we have a hard time getting an approval offer accepted on FHA versus a regular loan, right? Am I
that's
right?
yeah.
I
No,
mean,
that's true.
if you see an offer come in, right? I mean, you see an FHA or conventional. I mean, you lean towards
The
the conventional.
conventional.
Why is that?
Well, because more than likely it won't require me to jump through hoops.
When you say jump through hoops, like
So
what?
so it's less work for me. It's less headache
Okay.
because they're not requiring so much of you. They're not asking so much of you when it comes to things like repairs, and their appraisers may call out more items to be repaired. Where conventional, they're not going to call out those things. They're going to pretty much say, well, as long as the house is livable and they like it, we like it, and the market value is there, and it's a slam dunk.
Right.
Where if it's FHA, it's a little different.
Oh yeah. They require more, obviously, more items to be, again, if it has to do with any
Exactly.
health items, safety items, whatever it is, they do. I'll give you an example. Just the chipping eaves. I mean, that's not a big deal, but because of lead paint, they require you, hey, if there's some chipping on the eaves on the house, they require you to get that fixed before they move in. And
Right.
that's just labor and cost and like I said, more time. So,
Right.
Hey Marcos,
yes,
real
sir.
quick. Um, can you have Damaris check your phone to turn down the volume on your phone for the APN account? They'll still be able to hear, but it's echoing a little bit, they said,
You want to, she's here.
on the IG live.
Yeah, she's listening to you.
Okay. Yeah, if she could just turn down the volume on the phone a little bit, it'll be easier for them to hear on the IG live. But everything else is good. The
Awesome.
Zoom is good, and I also got the YouTube live going too as well.
All right.
And I want to shout out to Gina. She chimed in on my Instagram. So I know
Nice.
Gina likes Knoxberry Farm. So hang around. You might win some tickets.
Not on? Okay, next. All right, go on to the next slide. All right, appraisals versus purchase price. Estimated value of home determined by the third-party professional. So when it comes to an appraisal, because of the Dodd-Frank, the 2008-06 crisis that we had, so we no longer can call our buddy next door and an appraiser and have them do the appraisal. I can't do that no more because we predetermine values, right? So we have no. So what we do, we call on a third party, which called an AMC. And what they do, they schedule, they call, they don't even tell us who the appraiser is, who goes out there, just to make sure it's, unbiased, right? So make sure it's fair to everybody. And call a professional. we're not even supposed to even talk to the appraisers at all. If they find out we talked to an appraiser for whatever reason, they cancel the loan, no matter what in the process you're in. So it cannot talk to an appraiser. That way it's fair. Realtors can, they meet the appraisers at the house, and you can talk to them, and as much as I always tell appraisers, hey, get their card and, and make sure any question you have, let's give them a call. But definitely, so third party, so always fair for every party in the transaction. Purchase price, the cost of the buyer will pay for the property. So that's pretty much what is determined. And then loan amounts can only be cover the appraised value. So again, so let's say the appraised value, the purchase price is lower. So again, the lower of the two. So it can only be purchase price or the appraised value. So no matter, so it has to be lower of the two. So some instances, the appraisal comes in lower, right? Which we're seeing a lot right now, right? So guess what? We got to go use the lower one, not the purchase price anymore. So they have to be obviously renegotiate the price. Anything above that value will be paid out of the pocket. So in some cases, let's just say the purchase price is $700,000, and the appraisal for whatever reason came in at $650. Let's just call it, right. So guess what? So because we have to use the $650 now, not the $700, if the client really wants that house, they got to pay the $50,000 additional, right, over. Or in some cases, there's a lot of cases where the seller wants $700,000. Let's just call it, and we know that the price going to be lower, but hey, the buyer is willing to pay that difference. So in that case, we can't finance it, so it would be out of their pocket. So they got to be willing to pay a little more. Questions? Any questions, guys?
No, you did talk about if it didn't appraise, and you said the lower of the two.
Right.
If it doesn't appraise and it comes out lower, but the appraisal is higher, I mean the purchase price is higher, but the appraisal come out lower, can a buyer come in with additional cash to buy it down?
To buy it down?
Yeah, to buy down the price. If the appraisal, the value came in less.
Mm-hmm.
So, but they offered more. They were buying it for more. So
Yeah,
can they come in with the difference in cash?
Yeah, not cash, but yes, can be cash. Remember, that's a no.
Oh, it can't be cash?
We can't do cash, right? That's
So how would they fix that?
It would have to be in their bank. So remember, it has to be seasoned.
Oh, yeah.
Seasoned fund. Yeah, when you say cash, that's a big no-no for us. So we kind of, deter.
Okay.
But yeah, definitely, seasoned funds in their accounts. Absolutely, not cash. Because remember, it has to be the Patriot Act.
So they could use the seasoned funds that they have.
Right.
Okay.
And why is that? Because again, the underwriter looks at it. Okay, so they ask a lot of questions. So they want to know, hey, where the money come from? So they want to make sure it's not, money from terrorism or money laundering. So they got to make sure, hey, so that's part of not part of lenders. That's just the government's Patriot Act that they have. That's anywhere. So we got to make sure that, again, it's money seasoned in the bank for 2 months. So that's one thing we got to make sure you guys do have.
And can you just real quickly elaborate on that seasoned money? Because I don't think people know what that means.
Seasoned money. So if you need $20,000 or $10,000, that money needs to be sitting in a bank account or retirement account, any type of account where you can, generate a statement to show that the money's been there for 2 months. So a lot of folks I talk to, they got money sitting under the pillow, so what they tell them to do, hey, get that money, take it to the bank tomorrow and make sure and deposit it. So that statement that shows a deposit, I can't use. So we have to wait to generate 2 month statements without showing that deposit, because otherwise the underwriter starts asking more questions. And we don't want more questions. So yeah, just have to be sitting in a bank account. If you have a 401k, if you have an IRA, we can use, or maybe a life insurance, cash account. Absolutely. Anything that's liquid. If it's liquid, then we're fine. There's some accounts that are not liquid. So you got to check. There's a 401k, you got to check, make sure it's liquid, because sometimes there's not. I just had a client literally, the process right now, started the process, asked them if they had a retirement account. and it's not your normal retirement account, ask them, hey, first day, call them, make sure you can, how much you can withdraw. They got a rep on the phone. And then when my next conversation with them was, they said, yeah, they told us we can withdraw X amount. Well, guess what? 3 weeks later, when we're ready to withdraw the money, they called again, and the rep, another new rep, tells them, oh, I'm sorry, they misinformed you. You can't withdraw anything until you're 50 years old. The client's 48 years old. So that caused a little problem.
Right.
So you definitely have to ask a lot of questions.
So any mattress money, they need to put in the bank.
Absolutely. As soon as possible. If they're thinking of buying a house in the next 6 months, absolutely. You can't do it the day before, you're not buying a house. Unless you get a gift. I mean, there's ways around it, right?
But even the gift person has to show where the money came from, right?
Even the gift person, absolutely. If it's an FHA loan, you got to show, again, the donor's money or the statement. If it's a conventional loan, a little more lenient, they don't have to. But FHAs, they do.
So the gift person may have to have seasoned money as well.
They can't show they cannot show a statement showing that they deposited the money that they're using. Absolutely not. So that obviously shows, right? So you can't show that. That'll be,
Right.
they don't show it.
But
So
they
that-
have to show that it was in their bank.
Absolutely. Just 1 month. They don't require 2 months, just one.
Okay.
So understanding loan to value. Next slide. So loan to value, pretty much the way, to explain as easy as possible. Obviously you got the mortgage amount. In this case, let's just say you have an appraised value, say $500,000, right? So if you have $500,000 and let's just say your down payment, just for simplicity purposes, let's say it's, I don't know, $20,000, right? So $20,000 more, the mortgage amount, sorry. Let's say the mortgage amount is $350 and your purchase price appraised value is $450. So in that case, you would have a loan to value of 77%. So the higher the loan to value, the higher the risk. And sometimes the higher the rate. So you want to keep that loan to value. This is something you'll sit down with a loan advisor to help you understand how this works, because it definitely does affect you, especially if you're getting a conventional loan. It does affect the rate you get, because the higher the risk. Remember, lenders lend on risk. The higher the loan to value, so that means that's going to be a higher price. Same, and then also with the FICO score. So this is again in conjunction with your FICO score. So the lower the loan to value, the better rate you get. Questions?
No questions.
Pretty easy, right? Okay, this is the next one. It's the same one, no? All right, down payment. So down payment is amount of cash you put towards the purchase. Minimum down payments generally range from 3%, 20% down. Loan products with down payments as low as, again, conventional, kind of talked about, from 3% on conventional to 20% or more. Down payment assistance, we can do, again, up to 3.5% down. FHAs requires minimum 3.5% down. Jumbos, a little special, again, depends on the county you live in. Every county has a different loan limit. So it depends. So they start at 10%. So there is no 3.5% downs or 5% down. 10% is the minimum. And then you got the specialty products, which are those non-QM loans we talked about, which are 5 to 20%. USDA does not require, as well as the VA, you can come in with 0% down. So they have a big advantage over everybody. So absolutely. And again, down payment assistance programs, definitely, like I said, they cover the down payment where you just come in with your closing costs. And if Veronica, if you have a great agent like Veronica, she'll fight for your seller credit and possibly even come in with less than, that you can expect.
Yeah, can you elaborate on those buyer assistance programs just briefly? Because I know we're out of time.
Yeah, there's several. I mean, there's several of them. I mean, there's, oh my God, we use some that are GSFA. CalHAFA is a big popular one. Dreams for All. I mean, we just closed a couple of Dreams for All, which they were giving away 20% down, which we had a webinar, live one actually. So thank you guys for coming as well. So definitely, you know, we can do no webinar on just down payment assistance program. There's so many out there. So depending on your situation. I mean, so and if you're first responders, you actually get special pricing, believe it or not, and closing costs. So definitely can help you with that.
Okay, cool.
Hey, Marcos, what do you mean by first responders, real quick?
First responders would be like your firefighters, police officers, nurses.
Oh, okay.
So first
EMTs and
responders,
all that.
yeah. So they get a closing cost assistance. We call it the STAR program. So they get definitely you know, discounts on their loan.
Nice.
Yeah. So take care, you know, they take care of us. Why not take care of them, right?
And I have a question on down payment. Can you give just a scenario for a FHA buyer
Mhm.
and a dollar amount of what that down payment would look like?
Give me a purchase price.
And I know there's loan limits. Okay, but I'm gonna go with 850.
So 850,000.
Yes.
So I'm gonna use my calculator. Okay. So we have this nice little calculator on our phones we can share. So if anybody wants a link, just let Veronica know, put it in the chat. Definitely we can send you the link. It has a nice little calculator, which I love. So we're gonna do it. You said FHA, right?
FHA, 850,000.
Purchase, okay.
What would the down payment look like?
So the down payment is 29,750, which is 3.5% down of the 850.
So the person would need roughly around 30,000 cash.
3,000 cash.
30.
29,000.
Oh, 29,000.
Yeah, if they don't get down payment assistance, right? Because remember, if they get down payment assistance, they cover it.
Okay, so down payment assistance can even go as high as 850. It doesn't matter the amount.
It depends on the county loan limits. So as long as it covers the loan limit. So LA, if this was LA County, yes.
Okay. And I have another question talking about down payment assistance. Do APM do any programs like with Section 8 as far as home buying, those type of agencies?
I haven't done one personally.
Okay.
I don't know on Section 8.
Okay. But we do do the down payment assistance. Okay. Okay.
And the last one, guys, so last section would be capacity. Check what we got here. So must verify funds. We talked about that, you know, make sure the money's seasoned, kind of we're ahead of ourselves again. Some of the stuff they look at down payment, closing costs, reserves. In some instances, depends if they have a rental property. They do require that they have reserves for that rental property. So if you have more than one property, you're gonna have to have reserves in the bank or your retirement account. And these are some of the acceptable funds, which again, checking, savings, mutual funds, 401ks, gifts are acceptable. So if you need a gift, definitely you can use it. Depends on the program, but definitely for sure, it's not a problem.
So when you say reserves, explain that to somebody might not understand that.
So reserves, let's just say, take for example.
What does that mean?
Yeah, so great question. So let's just say you're doing a purchase and they're buying a house, their new house. Now they're gonna rent their house. Maybe they're departing house property. So now on that property, let's just say the payment is $2,000, $2,500. So they gotta have, at least depends on what the DU, we run an automated generate a qualification. So it depends if it requires 3 months reserves or 6 months reserves. So if the payment's $2,000 and it's 3 months reserves, they're gonna have to have $6,000 in the bank, just sitting there, on top of their down payment and on top of any closing costs if they have any, right? So because they have a rental property. Now they have more than one property, that's multiplied by each property they own. So they gotta have that money sitting there. I mean, they're
Okay,
not pulling it out. They just want to make sure, again, they have that money in case of an emergency.
got it.
The tenant doesn't pay, then guess what? The landlord has to pay. So when you get, again, when you start having multiple properties, it does get a little trickier. So you gotta make sure you have money in the bank
Got it.
or any type of account like what you see here, acceptable funds.
So, Miss Tanyika in our Zoom live, I appreciate her for coming. Thank you, Tanyika. She said that she wants the link. So if you guys mentioned the link or something.
Oh, yeah. Veronica, do you want to share the link from your app?
Yeah,
The
sure.
mobile? Perfect.
Definitely.
And if you need
Can you
help,
share that in the chat, Mom?
I will definitely send a link.
yeah, I think she have to give you
Yeah.
her phone number, and then she can share it.
Okay,
Yeah. Or you could type it in the chat too. Is it an app?
It's an app, yeah. It's an app.
Okay.
So just provide the phone number, and then Veronica
Mhm.
sends you the link. So
Yeah,
moving
also
on,
to
guys.
so go over
email.
the income requirements real quick, because I know AJ said we have to make it a part 2.
Yeah, so income and employment. So what do they require? What's needed on non-QM on a regular qualified mortgage? So 2 years of employment, same line of work preferably, depends on the type of loan you're getting. Schooling also counts. So if somebody's gone to school, let's say to become a nurse, they just graduated last year. So obviously they haven't been in the workplace for more than a year. So that 4 years of schooling does count towards their 2-year requirement. So that's pretty neat. So they can
That
use it.
is, that's huge.
Yeah. So again, that diploma, again, has to be accredited school. So the diploma does count towards the 2 years. So literally, I've had clients that have been literally just got a job. They've been on a job for 2 months and they qualify for mortgage. Commission overtime definitely count and bonus as long as we have a 2-year history that they've been receiving it. We have to average it out and see where it's at again. And gaps are okay, depend case by case. So it depends if they've been out of work for 6 months. They do require they're back to work 6 months. So they've been out only less than 6 months. We don't need anything but just a letter explanation why, and they don't have to be back to work for 6 months. So gaps are okay. For self-employment, depends again the tax returns that they file. Definitely need if they're a corporation, 1120s, 1065s. If there's sole proprietor, there's Schedule Cs. So definitely for 2 years. Where a non-QM, going back to the non-QM, they only require 1 year. So if they own the business for more than 25% of the business, sorry, then they do have to provide these. If they loan less than 25% of a business, they don't have to provide it. Okay. And definitely need some type of business license. And it really depends on the type of business they have. So some businesses do not require a license. So definitely it's not needed. So it depends on the type of business they have. For investment retirement, I mean, we can use Social Security, for example. Somebody retired can definitely qualify for mortgage. I get a lot of those. They're co-signers, or they have a property. So if they have a property and they're using it as an investment, we can use a percentage of their rents. Depends what they're. Now, so a lot of folks mistake always, hey, I have a contract. It says I collect $2,000 of rent. It's not what you collect, what your contract says. It's what you report on your taxes, what matters. So what matters is what you report on your Schedule E. So if you report a loss on rents, then guess what? That's going to pretty much get transferred to the loan application, and it's actually not going to help you. So it really depends. Again, going back to sitting down with your loan advisor. If you're buying a house next year, year is over. Sit down with your loan advisor, and if you don't have property or whatever you have, sit down with them. Make sure that you guys have all your ducks in a row, because it really matters. How you file your taxes. I get a lot of people you know, before they do their taxes, hey, they kind of sit down, hey, this is my situation, and this is what we're looking at. So that way, you make sure that you qualify, you have no issues when you start looking for a house. And again, other types of consideration, 401ks, we talked about those. Those that depend on your retirement, we can only use 70% of the balance. So whatever your balance is if you have $100,000 in your retirement, I think depends on the administrator, but most of the time you can only borrow 50%. But we can only use as assets 70% of whatever that retirement is. And child support, absolutely we can use as well, so as long as court ordered. So I had another situation, a lot of situations, but where a client was getting child support, where they're paying, but it wasn't court ordered. So can't use it because, again, it wasn't ordered by the court. So there was just a verbal agreement. So verbal agreements don't work. So it has to be in writing by the court.
Okay, cool.
Cool. All right.
We got
And-
about 6 minutes, Marcos.
Oh, perfect timing. I think this is our last slide, I believe, right? And we have the
Okay,
drawing.
awesome.
Then we have that drawing. So
Yes, sir.
get that drawing ready, guys. So
Personally, I think Tanyika needs to get it, man. She registered.
you registered?
She registered and she showed up on time and she's been here and she asked a question. Or she said she wanted to eat.
So debt ratios, how does the debt ratio work? So here's a perfect example of somebody that makes $7,500 a month. Very simple. They have one payment, which, you know, car payment, $500 a month. The sales price is $350. Loan amount in this case is $332,000. Excuse me. They're putting down 5% down, and their mortgage is 30-year fixed at 4.25%, which that was a couple years ago, I'm sure. Not now. And the rate's a little bit higher today, right? So how does this calculate? How do we figure this thing out? So debt ratio, again, the last big piece of, again, besides we talked about FICO score, right? We talked about credit, you know, we talked about assets. Now we're talking about debt ratio, which is the big one, right? So that's the third piece. I call it the 3 C's of lending. So credit, collateral, and capacity. So capacity, your principal and interest is calculated based on the loan amount. That calculator that Veronica is going to share with you guys. Taxes are based on the county you're in. Insurance is based on your fire insurance. Okay, so fire insurance depends if you're a brush fire or not. And then you have that wonderful mortgage insurance, right? If you don't put 20% down, mortgage insurance depending on your, if it's an FHA or conventional. In this case, it's a simple conventional. So your total payment, PITI, which is again your principal and interest, tax and insurance, comes out to about $2,153. So what you get there, that's your front. We call it the front end ratio. So your front end ratio, which is just your mortgage, is 28% in this scenario. Now when you add your rest of your debt, in this case, for simplicity purposes, only one bill, one car payment of $500. So now we have what we call as lenders your back end ratio. So you have a front end ratio, you have a back end ratio. So we got to make sure we fit within that box. So your back end ratio in this case is 35%. So you have a front end ratio of 28% and a back end ratio of 35%. So this is what we do when we run credit and we do income. We're figuring these things out. So again, we have to make sure that it fits the box. And based on this is how we calculate debt ratios. And I know we're running out of time, right, Arthur? So
yes, sir. About 3 minutes left.
Last slide. All right, I think we're done, guys. So hey, thank you guys for your time. Any other questions? Feel free to reach out to Arthur. Thank you, Arthur, for putting this together. Veronica, thank you for hosting as well. So definitely reach out to Veronica, Arthur. Any questions you guys have, feel free to give us a call and we'll answer any questions you guys have. Okay, without further ado, let's do our raffle, and we're giving away again 2 tickets to the Get in here. You pull it out here. I'll shake it. I'll shake it.
Shout out to Damaris too for helping us out with everything.
Put your hand in there. Drum roll, guys.
Hey! Who's gonna win? Who's gonna win our scary farm?
The winner is
Kaylee Ramirez.
all right, Kaylee.
Haley or Kaylee?
Haley.
Kaylee.
Kaylee, where you
So
at, Kaylee?
Kaylee, if you're here, reach out to us.
Congratulations, Haley.
Kaylee, right?
Kaylee.
Kaylee? Hey, the tickets, guys, are for Friday, so they
Oh,
gotta
that's
literally
true.
pick them up before Friday. So reach out, give us a call. Our office number is 909-397-0900. The mayor's put it on the chat, and then that's it, guys. All right, thank you.
Awesome.
Congratulations.
Thank you guys.
Thank you.
Make sure you guys subscribe to the YouTube channel, like the video. Thank you to Marcos for providing all the information. We appreciate you. And shout out to American Pacific Mortgage Company.
Thank you, guys. All right.
And shout out to my mom, Veronica Jones, for asking great
All right.
questions.
Until
You're
the next
welcome.
one.
Thank you.
All right, guys. Have a good one.
All right, see you guys.
Bye, Marcos.
Bye. Bye.
Thank you, Tanyika. Appreciate you. We'll be in touch. We'll contact you. Bye, Tanyika. Appreciate you for registering and chiming in. Your presence was awesome.